Hello, good morning, ladies and gentlemen. As always, we start with the most important market sector, which is yields, the 10-year. And here we are, basically stuck exactly where we said last week we'd be stuck, at the lower Bollinger Band, doing not a lot. It's very tight, but it is beginning to unfold. This is the 200-day moving average right below it, and this is the trendline support. Don't much like trendline supports in bonds, far prefer these levels. And here we have a level that it's traded at for a long time, just above 285, and it's basically holding it at the moment very nicely. You can see how bonds go from one yield level to another yield level and so on. It is only if we start taking out, I would say, this kind of yield level around 281 for a repeated period of time that we are in trouble. At the moment, this is just sideways trading. Do not get overly long of bonds unless we start seeing yields below 281. That's all that there is to be said for it. This market is basically in a wait and see mode. We have some quite interesting stuff happening next week, i.e. we have Jackson Hole, we're going to have a whole load of comments from central bankers, and that could give us an impetus either way. But for the time being, while before we were worried about the upside, now we're worried about the downside. We have seen certain things happening in the spreads which we don't understand or don't like, and that's why we're more worried about the downside. We're going to be far quicker to do something down here than we are to do something up there. Up there we are probably quite happy to sell, while down here we are not so sure. So every time that you think there might be a risk-off move happening, it is very important to give it time and to try to understand why it's happening. We don't at the moment, and we are out of it. We would not, while before we were very happy to sell calls in the futures and basically puts in the yields, we are not so happy about doing that at the moment. Our positions are pretty square in bonds, and we want to react as opposed to having to hedge. This is a chart of the 10-year in the States yield against the 10-year in Germany. As you can see, and we have referred to this very often, this will give us the next important move at some stage. You can see how tightly it's been trading basically since the beginning of the second quarter of this year. Basically, it's stuck in a range of minus 258 basis points to minus 248 basis points. That's a 10 basis points range. This at some stage is going to break big time, and when it does, the move is going to be horrendous. Now, we naturally are still of the opinion that it's going to break towards more negative, but who knows, the markets are there to surprise us, and it could break to more negative. Less negative would imply that German yields are actually beginning to converge with US yields, and that would be very bearish for the dollar, or at least it would slow the dollar down a hell of a lot. We still think that the only reason why US yields are where they are and they haven't gone higher is because there's a lot of liquidity coming out of the QE program in Europe. That money is being sold. The euros are being sold for dollars, and the US 10-year note is being bought. Well, if we are worried about the downside in 10 years in the States, then we are worried about the downside in bonds, quite obviously. But this indicator is the one that we are waiting to break either way on a closing basis. Either we close below 258 or we break the 248 level, or even 245, and then we start going up. We will keep you informed about this because this is as important as it gets. You can see the period here, and basically this is the period which gave us the biggest turn in the dollar. It basically killed the euro at stone dead and gave us the move in DX of 400, 500 points. So for the next moves in DX, we are looking at this as an indicator, and we will tweet it to you as soon as something interesting happens. Well, going on to DX, the situation is very much as we thought. 96.50 is proving a very tough nut to crack. We basically broke down on Friday. People are taking profits simply because they don't know what Jackson Hole is going to bring. The natural level for this to move down to is somewhere around 95.07. That would be the natural support, and we certainly wouldn't want to be very short of dollars once we hit that level. Basically, that is what we're looking for, that is what we're hoping for. No more than that. We would not be surprised, however, at some stage to see this 95.50 level cracked quite seriously, and the dollar making another move higher. It is unlikely to happen for a little bit of time, we think. That is why we've taken the profits above 96.50, and that is why we're looking for the market to now come down and then make a basically for weeks make some sort of a bull flag and then go again. But that is all we can say at the moment. We are not buyers of dollars. We are at these levels, we're buyers of dollars somewhere around the 95.30 to 95.07 area. 95.30 to 95.07, we will no longer be short anything, but we'll probably start building a long position again. What is going on with the equities? Well, it's very interesting. We don't really well, I mean, we do understand what's going on, but we don't think we're in a breakout phase either way as yet. This is this ratio that we've shown you 100 times, SOX against the Japanese yen, is to us beginning to be very interesting simply because it's deciding that it's breaking down slightly. We are, I mean, you know, in spreads you cannot really be as precise as this trend line. It's closed right on top of the 200-day moving average. The 50-day moving average is coming down. This spread is a leader for what happens in technology, and technology being a quarter of the S&P, of course, is very, very important. We are in the process of breaking down. We've made a lower high. Now we would like to see a lower low. Whether we get it or not, absolutely no idea, no bias. But what we are saying here is that if it were to happen, it's going to be extremely, extremely important. Why? Well, look at this period here. This period here in 2016 is what this spread led it. Basically, this spread has led the upside and led the downside. It is a real leader. So here we have a situation that you would have been out in basically July or August 2015 when this spread started moving negative on with a 200-day moving average in a downslope, and you would have bought it back basically late October, early November of 2016, and you would have been in it still because this 200-day moving average is still pointing upwards. Well, what is that? That, if you look at NQ, is This is a daily chart of NQ. Here we are looking at October, November 2016. Where was the market? Well, the market was 4,800. Okay, so this spread would have held you from 4,800 all the way to the present day at 7,400. That, you will agree, is a very good risk reward. So when that spread starts actually moving and doing this, that's very significant, and be sure that we will tweet any updates as they happen. This spread is probably new to you, and it's something that we tweeted before I went on holiday. Basically, sell volatility in the States and buy volatility in Europe. As this goes more negative, that means that the volatility is higher in Europe and lower in the States. We tweeted it about here when it was trading at 35 points. So you could have about here. So you could have got a premium for buying volatility in Europe and selling it in the States. Well, you can see how far it's gone, and this has actually been our biggest position for weeks. It's gone to minus 200. We don't think it'll last here, and in fact on Friday we got out of just about everything. We're not thinking of doing it the other way simply because it's a reaction. We still think the primary trend is that way. But what we are saying is that Europe has reached levels of undervaluation against the States, which historically have produced a bounce in Europe against the States. That is why it's no longer worthwhile holding the spread, and therefore we are probably more biased towards bounces in Europe for our sins. I know it's very popular to think that Europe is going to hell in a handbasket compared to the States, but we think the market has reached such levels of overvaluation that it's probably not a good risk reward to have that on anymore. But you can see how much money you could have made just by holding a simple volatility trade. You could have made 235 basis points, which is a huge move. And therefore we think that 99% of everything between Europe and the States is now discount. And this is the tweet here from July the 23rd about stocks, volatility against volatility in the States. We do a lot of these things, and if you ever want more information or you want to pick our brains about something, please just dial us up on Skype. It's a charity hedge fund, and we're more than happy to help you, even structuring these trades or explaining the reasons and where we think any stop should be, ratios, anything at all you need to know. This week I would like to concentrate on XLK simply because things seems to be shifting a little bit. We have situation is very unclear. I mean, the market closed exactly where it should have done on Friday to make it not obvious what is going to happen next. Put it this way, I really would not discount and move up to 7,550 over the course of next few days. People have probably got too short of it. But what I'm saying is that even if it goes up there and starts making marginal new highs, it's just not looking as impetuous and as strong as it was looking before. We are getting a whole load of divergences on the technicals. Are we in the ninth inning of technology? Well, it's quite possible. I don't want to say it for definite, but what I'm saying is that I am certainly shifting quite a bit of money out of technology into more defensive sectors, simply because I am not so sure anymore and I don't know. We have been making higher highs, and this could be the potential for the first lower high, but it's just so labored this sector has never really been labored. It's always been strong. Um, and it just feels different. We are nowhere near the 200-day moving average. We are in the middle of the Bollinger Bands. Nothing is screaming sell me. Nothing. But it just feels different. Well, that was an introduction to this, which is XLK over SPY. We are very much at lofty levels. We are way above the 200-day moving average, saying that tech is really doing nothing wrong. But we are way above all the trend lines that we had and which have held since 2009. Uh, it would be quite normal and not be bearish, fundamentally bearish technology for this spread to come back down and test, for example, this median trend line. It really wouldn't. But that would be a huge move in tech, a move of probably 20%, which is something very much worth having. So that is why we are moving some money out of technology into less risky areas, simply because we think the risk reward at these levels is just not good enough, and it's something that we need to think about for the long term. There are many ways to skin a cat, and we always like to do some very interesting trades. This will make you see it better. This is actually volatility in S&Ps against volatility in the Nasdaq. Every time as it comes down, that means that the Nasdaq, the Nasdaq is more volatile than the S&P. You can see this is the spike that we had for February of this year, when basically the volatility in the S&Ps went crazy because of the problems that certain ETFs or ETNs were having. It very quickly collapsed back down to the lows. So the overall trend to us is down. You could have a very interesting trade here, being longer volatility on the Nasdaq and shorter volatility in the S&Ps, and look for the spread to come back down towards these extremes. At these levels, we are sellers of volatility in the S&Ps and buyers of volatility in the Nasdaq, which will give us basically a synthetic short of Nasdaq against the S&Ps. Finally, let's look at the S&Ps themselves. This is a daily one. Basically, not a lot to say. Last week we said if we see 2805, 2810, buy it. We got 2803. Basically, it's doing nothing wrong. I mean, there is absolutely zero reason to sell it. None whatsoever. We are looking for 2870, 75 next week at some stage. Possibly then we get a reaction lower, but who cares? Every time it dips, it's going to get bought, and you should buy calls every time it does so, until the situation changes. Why preempt price when you don't need to? If we look at the weeklies, where are we in the weeklies? Well, we are very much... Why is this not working? Let's try it again. Why are we basically bullish? Because every single trend line and moving average is pointing upwards, and the market is not violating anything at all. We are basically now stuck in a range, and we can see where the Bollinger Band is going to be next week. It's going to be around 2885. So what is likely to happen? It's likely that we will take out these highs that are around the 2872 level in the SPX, get everyone bullish, take it up 10 points or so, and then probably come back down, and then probably go back up. I'm not an Elliott waiver, but I do know that this is basically some sort of a basing formation for an acceleration higher. Whether this is a cup and then we get you know, whatever you call it, and then we go higher, I don't particularly care. I know that I am invested, and I will continue to be invested until there is a reason no longer to be invested. I am probably not bright enough to know when that will happen. All I know is that I'm reducing my very high beta positions. I'm moving out of some tech names. I'm moving into more defensive names. Basically, I will show you a couple of interesting charts next. This is XLV, so basically large pharmaceuticals, medical, etc., etc. They've done very, very well over the past few weeks. Probably a little bit of a retracement, cup, handle, go. It's a defensive sector. I keep on selling puts against it. I prefer it than being outright long XLK. It might make me a bit less money, but it's certainly a lot safer. If we look at utilities, they're not doing anything wrong. Basically, they are in a very nice uptrend, managed to get some round here. It's breaking up higher. It'll probably take a bit of time to reach the level. So, you know, still buying utilities, still buying basically the stuff that nobody wants when they don't want it. XLP, again, when we're around the 50 level, loved it. Around 55, yeah, not so sure now. We'll probably stall a bit and then go again. So defensive sectors are the ones that I prefer to buy the dip in. Certainly XLK is the one that I'm most afraid of at the moment, not because it's giving me absolute sell signals, because it's not giving sell signals. It's just giving me signs that something could be changing in the internals. One thing I don't understand are all the people who are bearish the US stock market and want to be in a permanent risk-off phase. There is nothing risk-off about this chart. This is 10-year bonds against the S&Ps, very much still in risk-on. We might be, you know, so running out of oxygen up here, but there is nothing which is telling you that you should be shorting the US stock market. Absolutely nothing. It's a question of preference, whether you want to be invested in a more defensive sector or a more aggressive sector. We would prefer to be invested in more defensive ones. We'll probably make less money, but that is not a reason to abandon the US stock market. It's doing absolutely nothing wrong. One thing that I would like you to be aware of is the basic retracement that we're having in EEM. We are now approaching the 50% retracement of the whole move up, and also we have the 200-week moving average, all slightly below 40. We're trading 42 something, so that's 5% away from a very, very important level. That, if you have money to put to work, is where you really put it to work in EEM, and basically forget about it for the next 5 to 10 years. So looking for the biases of the week ahead, this is what we said about 5s and 10s, still no change, nothing has changed there. Bunds and bobble, well, Italy is the focus, Germany will be bid, exactly what's happening at the moment. Germany is untradeable, only through options. You never know, the Italians might make some stupid decision next week and that spread just goes ballistic. Here we are, cannot see significant strength below 28.30 if US dollar is strong. The dollar started weakening. 28.10, 2800 was the level you should have bought. And what do we think? 28.25 to 28.75 range next week. This probably even comes up a little bit, 35, maybe this 85, who knows. But that is basically what we think the range will be next week. Who cares whether you are out 10 big figures? It's immaterial. It's still going higher. That is what we're saying. And if you read this, it just says what we think. Our least favored position is selling this in a hole. You've seen 28.05, excellent risk reward for longs. It's just true. Every time it dips, you should be in there buying calls, buying call spreads. It's just what gives you the risk reward. NQ, it's becoming, it's giving up the leadership. We think, if we cannot break and stay above 7,500, you could get a 15% move in NQ at any stage. That's why we like that trade that we showed you, and that is long volatility in the Nasdaq and short volatility in the S&Ps. That hedges just about everything. Nothing changes in XLF, nothing changes in anything else. The dollar is the important one. As we said, 96.50. It should hold for quite a while. It has. We bought a bunch of puts at 96.50. The market's gone down. We are happy. Around 95, 95.05, we will reverse and be long of dollars again through options. Volatility in the currencies is so cheap, but so cheap, that if you don't trade options as opposed to the outright, you're making a basic mistake. Thank you very much indeed, and speak to you on Monday.